Okay, it's 11:25, which is the time when we are supposed to start. Welcome, everyone. Welcome to the next part of the event. My name is Paweł Szaj. I'm a capital markets partner at Shearman Sterling, and I don't want to use the word moderating because it's not really a panel discussion, but I will be leading and facilitating this discussion. We have a distinguished list of colleagues and participants here at our event. We are still waiting for one more person to join. It's Tom from S&P Global. Hopefully he will join. He's in the United States. Let me introduce Juliette Suleiman. Juliette is a VC investor and MMC Ventures, which is one of the UK's leading venture capital firms, investing in pre-seed, seed, and Series A deals with over 500 million under management. She's also the founder of Ground Floor Ventures, a UK business angel syndicate, investing in early stage deals across Europe and the United States. Prior to that, Juliette was Chief Commercial Officer and General Partner at and has done many other exciting things, including being a VC investor in Octopus Ventures. So that's just a brief introduction. And Anishs, many of you may know Anishs. Anishs is the CEO and founder of Air. Is a credit scoring fintech company, of course. He previously co-founded Fabricate, and his past experience includes corporate finance for specialty finance and fintechs. Educated as an engineer with a second degree in finance, Anishs was recognized as the European Commission's Entrepreneur of the Year 2014 nominee and British Council 2009 Young Entrepreneur. So that's the introduction. Just before we start, one more point. You may see on the right-hand side, there's on the polls, there is a question. There's a question for our audience about the financing sentiment in the fintech ecosystem in 2021. As we go and as we talk about exactly this, about the corporate finance, the financing, what it means to finance and how you finance fintechs this year versus how it was done last year and what we expect for next year, please respond to this question. It will be very interesting for us to see what people think. The questions are relatively simple, so please have a look. Okay, so without further ado, before we start, and hopefully Tom will join us very shortly. Why don't we start, Anishs and Juliette, by you giving us a very brief overview of how you view 2020 in terms of trends, in terms of financing. What is your view in this very strange and unusual year?
I can start, I guess. Look, 2020 obviously started with a lot of hope and expectation for everybody, right? It's the year 2020. We were going to have flying cars and, you know, beat me up, buddy, and all that good stuff. But obviously, when March came around, most people had to start changing plans. Some companies obviously had a much harder hit, depending on the sector you're operating. And some companies on the flip had an extremely positive outcome from this in a business sense, right? Obviously, there's the Zooms and the other sort of collaborative. In fact, even Hopin that we're all on today seems to have done really well out of this. But I think from a financing perspective, look, there's one truth that always remains, which is if you're a good business, if you're doing the right thing, if you're managing yourself well, if you're prudent with your cash, you don't have frivolous expenses, and you can care about the raw metrics, the unit economics of who you are, what you're trying to do, you're always going to get the right kind of money, right? That's never going to change. That's just the fundamental truth in the business and in the sort of ecosystem. I guess what it does is it starts affecting the chain, sort of the long chain of businesses downstream, where there's sort of the mediocre average businesses that have maybe been kind of propped up by excess liquidity. I think some of them start falling away or having to learn how to shape up really quickly. And then really comes the tail end where maybe, in the past, pre-COVID, there'd be businesses which were, I don't know what the word is, like the Walking Dead or the zombies, which are, effectively done their time. They haven't proved much, but they keep pulling up some lifeline capital because it's available. And I think in many ways, those businesses had to fold. And it's in a way, it's positive because it allows people to come out and go to new things, learn from those mistakes rather than trying to just keep propping something up. So those are the three big outcomes, right? And I think there's that Warren Buffett or somebody who said that right idea that if it's only when the tide goes out you realize who's doing naked. Right? I think that's sentiment so valid, and you can see this in the public markets. You can see this in the private markets. It's absolutely important. So good businesses, well managed, no problem. Keep running.
Juliette?
Yeah, I think Anishs is spot on on that. I'll give you kind of the politician answer by starting by telling you what hasn't changed from previous year to this year, and that is fundraising is hard, regardless of if we were in 2019 or in 2020. From a VC perspective, the amount of business that we see is about the same, right? We see on average, a fund will see on average 5,000 business opportunity per year. They'll take 300 to 400 business meetings, face-to-face, or now should I say video to video, but like actually spending time with the business. And they'll invest in between 10 to 15 business per year, depending on the size of the fund. And this statistic hasn't changed from previous years. So, I mean, it's difficult. And now the question remains, how do you start being one of those 5,000 businesses and become one of those 10 to 15 businesses to get funded? And I think Anishs is spot on. The venture game hasn't changed. The capital business model hasn't changed. You're still looking for amazing economics, amazing businesses. If you are this type of business that have been kind of clear on how to deal with the right unit economics, I think there are still plenty of opportunity to manage to get that.
And Juliette, on average, just looking at the sheer number of deals last year compared to this year, have you done more investments this year to date? We are already in December. The year is almost over. 2020 compared to 2019, or is it roughly the same number?
Yeah. So funny enough, actually, at MNC Ventures, we were doing one deal per month approximately per COVID, and during COVID we were at 1.3. Deal per month. So I think it's accelerated, but that again go back to the point that venture capitalist as a business model hasn't changed, and we raise more money. And this money that we raised prior COVID, obviously, we have to deploy it. There is nothing worse than idle money that is not producing return. At the end of the day, we need to find those opportunity, and we haven't closed the shop. And I think COVID has obviously been tough on a couple of business models, but also brought a bunch of really great business opportunity and funding opportunity.
So what I'm hearing, and for everyone in fintechs or startups who is listening to us, it looks like there is a lot of dry powder. So if you are good, if you are good, there is still a chance to be funded. Anishs, how you mentioned, and your point about you're a good business and you're gonna get funded. What does it mean to be a good business this year? What makes that difference, and what makes people focus on you as opposed to 500 other businesses which Juliette mentioned?
So I think like I said, the fundamentals really have to shine through, right? I think we've been all a bit guilty in, I'm sort of generalizing, in the tech sector, where occasionally there were businesses that were ignoring the very fundamentals of what it means to be a business, right? Like, do you actually have a business model? Or are you just kind of trying to gather a lot of users and hope one day that magic happens, right? So a lot of those businesses have been challenged to either push to really innovate to get to a business model faster, or start turning on that business machine, right? The monetization machine. Bottom line is, if you are not starting to look like a company that can stand up on your own 2 feet, not within 2020, but in the coming years, then people start really wondering, are you ever going to get there, right? Some of those things that people kind of look past are going to be questioned a lot aggressively. And the other side of it is just, and most businesses have done this, I think, through the summer months, just sharpening their internal structure of operating. Are there some frivolous costs that they're carrying because it used to be cool? Somebody was sharing this joke, like in Silicon Valley, I think, at least, the number of ping pong tables that were being listed on Craigslist to be sold because companies were either getting out of their office, or they just, obviously the ping pong table is kind of like the icon of the lifestyle of what a culture of a startup is, but it's also, partially leaning at like the frivolity that is. So those fundamentals have to be maintained, I think. And some businesses have actually used COVID to kind of clean up their product as well. And I think that's really interesting when you see that, right? So they realized maybe their product was kind of getting bloated and they were trying to do 10 different things. But because of COVID, because of the pandemic, because of the work that we live in, the environment we are in, it's been a good opportunity for some of these businesses to shave off some of the excess features and things which were really kind of just hanging around for no reason, and streamline and focus on the things that I think are ultimately going to get them, a standalone structure. So that's I think the hallmarks of what you would still see in a good business. And without sort of forgetting to talk about it, I think it's still really important for businesses to maintain who they are, their culture, their ethics. I mean, this is a time when you're really pushed, and businesses that forget who they are, why they started, what they're trying to do, I think they will not have a very long lifetime.
Yeah. Anishs, maybe one more question. So you did a Series B funding round last year, right? 8.5 million, if I remember correctly. And if I understand, you haven't done any financing this year. Is that right? If you were to do a Series C this year, how would you do it from the, let's say, from the execution and valuation perspective? Would you go for equity financing, or would you go for convertible maybe? What's your view now?
Yeah, look, I think if we've been fortunate that we're not in a situation where we had to immediately go out. We had our cash capital, and we did a few things to extend the runway. But most businesses, unless you really have to, you don't want to be doing a large equity raise in the midst of all this, where there's chaos, there's uncertainty, people are not going to show up maybe to the party, so to speak. So if you can, and I know there's been a lot of discussion around how convertible notes are pretty interesting, because to some extent, not always, to some extent, they're able to kind of allow you to get past this current wave without having to talk about the pricing question. But that said, also some businesses have benefited so well from this that you kind of want to lock in a price, because what was it? I think it's a publicly listed analogy, but I think the few days after the vaccine started coming together and the news kind of broke, I believe the Zoom stock price started collapsing. Not collapsing, but coming down significantly, right? So in many ways, there's also some companies which will like to lock in a price now because they can kind of ride that wave. And that's both sides are going to happen. But no, we will be out in the market in 21. So we were able to not have to raise in 20.
Juliette, what's your experience? And what have you been hearing from companies? Do people want equity investments? Do people talk to you about convertibles? Do you also focus on convertibles, or are you doing only equity investments?
No, we do both, but I think the question here is more. I think it's a strategic question more than anything, and I think for a founder the question is, how much time do I want to dedicate to fundraising? Because let's be honest, right? Fundraising takes time and takes the eyes of the founder out of the business itself to fundraise, and that can be quite painful. And ideally, you want to do that as fast as possible, create a momentum, be quick, fast and quick in the fundraise, be done, and to the next challenge, right? And so I think my general view on convertible, it's great if you don't have the milestone yet to have a very bullish valuation, the valuation that you want, that you know that you have a couple of contracts in the pipeline that will boost that valuation once they're done, but you need that dry power to get over the line. And here, going back to your current investor and doing a convertible note is clearly a great way of navigating that space. Now, again, my biggest concern when somebody is telling me that they're doing a bunch of convertible, etc., is that what's the strategic point of view here? I think in the mind of a founder, I think it's really, really important that the founder take a very, very clear timeline of the fundraise, be very specific. I want to be in fundraising mode from X months and be done after that. Because the most important is to be building the business.
Well, one more question for both of you. So in the current financing climate, would you, and I believe the answer from both of you will be, from each of you will be different. Do you see investors as having more leverage and being in a better position to impose more investor-friendly terms, or do you think not much has changed in 2020? Juliette, let's go with you.
But I feel your question insinuates that maybe investor or what was the like? I don't think the balance has changed. I wouldn't argue that the balance has changed. At the end of the day, the best business out there are competitive deal. They have the power. We as investor have to really sell ourselves as why we're the right fund and right partner to be the partner with a founder. And I think there is kind of a misconception overall in the industry about, do I want the highest valuation ever? And you think that the founder would want that and the investor wouldn't want that. The truth is you want the right valuation at the right price at the right round. There is nothing more dangerous for a founder to overprice his or her rounds, because it's just going to be, imagine the pressure that it puts on the founder to actually realize that valuation in 18 months. Good luck. And if you don't do it and you overpriced, you have a down round. And I think the down round is probably one of the worst things that you can announce to your investor and to the. So I wouldn't say that the balance, really, the power balance has kind of changed. And I would argue that if you are a really great business, and again, going back to what Anishs was saying about having the right KPIs, having the right unit economics, having the right mindset of thinking of the business model, etc., you're going to be competitive and you have the power, as it should be.
Yeah, and I think Juliette made a really good point there, that it's, for the best companies, it's the reverse, right? They're kind of price setters, if you may, a little bit. The funds are coming to them. I mean, the only one thing I'd add is, and it could be anecdotal, but I do feel, and maybe over the summer I started feeling this, that some more funds have become a little bit more strategic and a little bit more thesis-led. Because of what's happened. So a lot of funds used to just be opportunistic as things came in, or what looked like a good deal we'll kind of jump on. But I found a lot more started becoming thesis-led. Obviously, there's a whole group of thesis-led funds which are their own category, but others kind of joined in because they said, because of COVID, X will happen or Y will happen, and therefore we're going to go find companies in X or Y sector. So that's also become interesting, where some funds have become very targeted about where they kind of want to push their dollars or pounds, and something to keep in mind for founders.
Just going maybe to the practical side, how deals are done this year, Juliette, how do you execute your deals in this digital age right now? I mean, I imagine it's less face-to-face contact, more hopping Zoom online. Does this make any difference to you, or do you think the face-to-face physical connection between human beings, is still very important?
Yeah, I mean, I love meeting people. I think it's such a people business. I love having my glass of, I'm very French, I love having my glass of wine with the founder to see if we can do it right, etc. But I'll say that, it went, like the deal went online. And I think this is quite game-changing for first entrepreneurs that are not based in where the money is, right? You don't need to be based in London anymore to meet VC, for example, which I think is a great news. But also just, I think, if your ability to leverage your power online and your network online has been so much more important nowadays. And when I say that, I think I can give you an example of one of my personal investments. I think one of my as a business angel, one of my portfolios that is doing the best, I slide into the DM of the founder through Twitter, and I did the deal on Twitter. And I think this is crazy for like the ability and the DD was mainly on her way of communicating on Twitter, like the founder on communicating on Twitter, on leveraging a bunch of a community. And I think those are key data that are becoming more and more important in the DD of VC, I would say.
Anishs, what would be your experience if you were to fund or to get a financing round? I mean, I imagine everything would happen online. Does this make any difference to you, or you think it's our life now?
We've already had a few investors, even in pre-COVID times. We have a large number of investors in the US, and some of them, I didn't meet them till after they funded us. So things are happening, they come together, they join the round, we invest, and then it happens that I fly out to California, and then I would have lunch with them. But that was a post-deal kind of thing. I think people are also growing up and understanding that, right? Look, we've done so many more things digitally than we thought we would not be able to do, right? And that's the kind of the shift that COVID's caused us as humans in our own personal lives to do. So it's only natural that even deal making starts moving online. Now I realize, obviously, for large ticket, complex deal, especially if you're going to be deploying, I don't know, like $500-600 million, there is that nervousness. What are we putting the money into? But also, I think one of the things that's interesting, and look, Air has taken a couple very interesting steps along the way, where we are becoming more and more of a remote-first company ourselves, right? So we are quite distributed now. We have obviously people in the US, we have people here, we have a couple of people on the continent. But more and more companies are starting to become that idea of a hybrid or remote company. So often when you're doing this sort of physical meeting, all you're probably getting to meet is one or two of the founders or the management team, because a lot of the team itself is actually distributed, right? I remember in the pre-COVID times, investors would come to our office, and they would come and see it and kind of see, okay, these guys are around, and we would make them a very average cup of coffee, but it would just be the idea of being in the office. Especially for a tech company, even the office, what is it like? Everything's written in code and it's on AWS. So what is the office really doing apart from just creating an environment for people to share? So that is something else that will also change, right? Yes, you might still want to meet the person in person, and maybe post-vaccine we can do that, but you're not really going to get to see the company. And there's going to be a difference between a few people at the top who are raising the money versus the rest of the company. And that disconnect is also going to be something interesting that all of us will have to learn and move on with.
Yeah. Maybe a slightly different question for you. So we are in December right now in the UK. So the negotiation around Brexit still continue. There's still a few weeks to go. So let's be a little bit political. So Brexit politics and fintech investments. I imagine, Juliette, going back to your points, which you mentioned, a good business is going to survive, will get funded no matter what. I imagine Brexit is not going to change much here, but do you see any knock-on effects from Brexit, the political situation? I don't know, maybe even how we will be structured from an organizational perspective, pre and post Brexit. Yeah,
I think it very much depends on which industry you are in. I would say that in my view there is a big I don't see London losing its spot as a European hub for fintech, regardless of what Mr. Macron like to brag about. I think fintech London is here to stay, and I think good luck to do that, because there is an incredible ecosystem, incredible high quality of companies. So I'm not too afraid on the fintech sector. Well, there will be classical thinking to be done through, I would say, B2C is going to be tough to export in Europe. They're going to be tax crazy on import-export. I was speaking with a French business that was doing quite a lot of export and import with the UK. And the founder was telling me that prices were going up like crazy because of Brexit. So I think, but from a B2B perspective, from an infrastructure perspective, if you're the best, what you do, I'm not too concerned. I would say.
Anishs?
Yeah, and I think the sector really matters. Obviously, if there's regulation and some of the regulation is localized, does it carry through the passporting, which is obviously a big thing for fintech. But again, a company is sort of two sides, right? So it's where is the company headquartered? And for fintech, there is still a very strong case for it to be in London. It's just the financial capital is not going to unwind itself so easily. Yes, banks are moving some people to Amsterdam and all that, but the guts are still staying here. So if I take us a little bit more of a fintech view on this, so the company might still be here. The regulators are the most favorable here. They're the most advanced in their thinking. But the employee base might start getting a little bit more distributed, right? And we're seeing this. I know other companies are talking about this. I've talked to a lot of other founders. So if you think about what a company is doing, it is sort of creating from nothing something, right? So the wealth creation that happens across the board which is either in terms of turnover or the employees and the salaries. Some of that will actually start getting distributed across Europe much better. So you won't necessarily have that, everybody's in London, all the VC money is coming to London, and all the salaries in London mean all the rents in London are going up. Maybe some of it will distribute out within the country, and then some of it might even distribute out to other places. And, there's companies telling me that they're hiring people in Greece now because there's a slight adjustment you can do in terms of cost base, and they're kind of working in the same time zone-ish. So that's going to be an interesting positive outcome. And it's not necessarily a Brexit outcome. I think it's still a COVID outcome, but, Brexit will also add a little bit of a sprinkle across that. So,
and how are you structured organizationally? Are your headquarters in London and most operations and people in London are distributed as you just
yeah, so
outlined?
We are a UK HQ company. We obviously have a US subsidiary as well. We have chosen to become a remote first company. So for our people, they're mostly distributed. Even I moved during the sort of pandemic. I moved a little bit further out from London to actually be at a better place for the schooling for my kid. But I've seen other employees also start making that choice to relocate for lifestyle and maybe more space, more greenery, but still being able to work in a London-like environment. And that's going to happen consistently, right? We do have employees, however, now who have relocated across Europe, so Ireland and Italy and Greece. And so there's that distribution that's starting to happen. We've also started thinking about how does that change our hiring strategy? Because talent is everywhere, right? And talent doesn't have to cross boundaries physically now. If I can find great data scientists and great engineers, great researchers, and they happen to be in a certain market because of personal choices, family choices, schooling choices for their kids, fantastic. They can log in, contribute, do their work, and post-vaccine, obviously, they can come in to meetings or workshops or planning sessions. But so much of the work can still be done from home. So it's a pretty bold move. I mean, we've taken. I know others are starting to take it as well. I know in the U.S. as well, the idea of distribution is starting to become quite common, and I think that's going to really change the typical structure of a company from what does it mean where the workforce is, what the employee base is.
Yeah. As we go, we are actually getting questions from the audience. So maybe I will just address two of them as we go, and then we'll continue. So question from Liz Lumley. You have mentioned some of the companies that the pandemic exposed as running on fumes. In fintech, how long will that impact last? Are we destined to go back to hype and smoke and mirrors, or are investors waking up?
Yeah, I'd probably say, again, if they're in the tail where they're kind of being propped up, I mean, the Walking Dead, so to speak, they'll start folding, and it's likely that, investors become a little bit more prudent to not allowing these companies to exist. Because you also got to reallocate your portfolio, right? If you have 200 million to invest, would you rather prop up a couple Walking Dead, or would you rather start putting it towards something that has a higher chance of making it through this?
Yeah. I think the question about how long will that impact last is quite difficult, right? I think there are many factors here. Juliette, what's your view on this question?
Yeah, I think it's. I would say that I'm still haven't myself made up my mind on this one. There was so much public money being thrown at a bunch of those startups to keep them alive. Is it good? Is it bad? And it's a very political question. It's a very if your neighbor are doing it, should you do it? I think you should. I think you should support as much as you can. I think venture capital are very much aware of that kind of statue of the startup should have died and hasn't died, and it will reflect on valuation, it will reflect on opportunity. And again, it's about the startup needs to have a very, very clear narrative. I think the most important for the startup is to have a very clear narrative of what happened for them in 2020 if they have been indeed impacted. But it's going to be a tough one. I think VC are very aware of it.
Yeah.
I would say.
And I think one point that we didn't talk about, but I guess it's related to this one, are the various support schemes, right? So it's not only in the UK. We have all the support schemes elsewhere in Europe, in the United States. Of course, the political reason and why we want to do it is clear. But yes, I've been hearing that oftentimes this means artificially sustaining life of certain companies, right? And once those support schemes expire, well, the natural conclusion will be that those businesses will fail. And I think Juliet, it goes to the point which you mentioned, right? So the best will survive, and these are just the forces of the market. I have one more question. This question is for Anishs from Liz again. How do UK headquartered companies deal with salaries for employees in European Union post-Brexit, especially smaller companies?
Yeah, it's a good point, and I think there's still a lot of discussion going on. So obviously, what we've done at AIR is obviously, regardless if you got hired in London and then since relocated to the EU, we will obviously pay you what you were hired at, and you will kind of be on the same ladder that you would have been on a London basis. Now, there is a second view, and I know in the US it's already started happening with Facebook and stuff saying, well, people might relocate from the Valley to, let's say, Denver or Boise, Idaho, or whatever, right? It's like, and then all of a sudden there will be a different lifestyle, different cost of base. And how does Facebook themselves, and they start talking about, we will probably have to reset you. Now, it's going to be tricky when you have an employee hired in one office and relocates, and when will they tell you that they've relocated? So it'll come down to some sort of structure the company has to find. The flip, which is when you're directly hiring employees in a different geography. Now, this really becomes interesting. Suppose you were still a London-based company, and now you've hired your first few employees in a different market, maybe a market where the costs are slightly different to London. Again, I'm just going to pick one. Greece, for example, is a common example a lot of people talk about. Good tech scene there as well. It is likely that you will start seeing companies, and again, being cost conscious, this is going to be a mindset for the next several years. People are going to have that question and say, hey, look, if I'm going to hire you in Greece, I'm going to pay you a salary that is commensurate with the local market expectations and not necessarily the UK-based salary. And there is a 20% difference or whatever the difference is. So that will start trickling in sooner or later because people are just going to have to mind their finances really, really well. I don't know, Juliet, if your company will start talking about this or sort of finding policies here.
No, I'll be cheeky here. I'll just say that one of our portfolio company called Safeguard is dealing with exactly this doing payroll for remote teams. I think you see quite a lot in fintech. Actually, this has been the year of a remote payroll company with quite a lot of money being thrown into the sector, and I think it's going to be a big space, and there will be company to support and. To be fair to and non-biased, I'll name a couple of others. Omnipresent in London, Deal in the US that has been doing really, really well, and obviously Safeguard.
Excellent. Okay, one more question. We talked a lot about London being the hub for fintechs, of course, and Anishs, your company headquartered here. How about other countries? How about emerging markets? Do you see, in your experience, Juliet, I don't know, what is your investment strategy? Do you invest only in the UK, or do you go beyond? Do you see a lot of trends and developments in emerging markets? We've been hearing that the Baltics are, for example, super active. There is a lot going on. Interestingly, the smaller the country, the more development comes from that, right? Here, I mean, for example, Estonia. So, are you looking at those countries at all, or is this not really your focus?
100%. I think opportunity are not geographically constrained. Now, I would say that to be a valuable partner, you need to clearly understand what is your value added, right? As a VC investor, even if you want to pick the next unicorn, if you want to use those terms, why are you the best to be partnering with a company, and what can you add to that company? So I wouldn't say that MMC is particularly knowledgeable on the Estonian market. That said, I assume that if you're a fintech, you might want to explore the UK market or the US market, etc. And I think here this is where we can add. So I would say that in terms of our sourcing strategy, we're pretty broad, but we would want to see some kind of like expansion plan to the UK, for example, where we could be truly add value in terms of have a clear understanding of the market, helping with your first hire, helping you navigating the regulatory ecosystem, etc.
Anish, what's your thoughts on this one? I know you're headquartered here. What have you been hearing from colleagues?
Well, I think the one really important stakeholder for any fintech company is the regulator. Often people don't realize how much of a difference it can make. And, we obviously had a choice. We could have actually launched in the US. So we were toying between the US and UK. But I know even if you look across the continent or even other geographies, depending on the type of sector or type of subsector within finance you're going after. Remember, fintech is such a broad space, right? It goes from capital markets to derivatives to blockchain to consumer credit, consumer finance. You might find that certain regulators are a lot more open about letting you innovate or experiment or push the envelope. And therefore, you might choose to launch in those countries first as a test market or maybe even to find scale. And I do think, again, this is one of the benefits of what remote work is creating. You could kind of launch in those markets, still be a company that's partially set up in a different market, have your talent pool in yet another third or fourth market, right? So that distribution is now allowing also new business models to come up where, primarily London-based company with its staff in EU could be launching strategically in Lithuania because there's a certain kind of favorable regulatory policy you can find there.
E-banking license in Lithuania, right? As we know. Very interesting. We only have a few minutes left, so before we conclude, couple more questions. Maybe just practical piece of advice, Anish and Juliet, from you, for companies that have never funded. What's your advice for them? How to best get ready for funding and what to do?
So I would say the two things, if you're really at the start of the journey, you're looking up at funding, I think it's really important to understand what is it that you're seeking the funding for. And the more you can answer that question and the more you can articulate that, it allows you to find the right type of investor, right? It might be that you don't actually need a VC type investor to get the ball rolling. Maybe that's your second investing round after the first one. And what you need is a group of angels coming together and giving you capital and just momentum and encouragement. It could be on the flip side, you're building something that actually requires a slightly longer duration of maybe research and R&D. And then even maybe the VC is not the right investment. Maybe you need a different kind of grant structure. There are obviously very successful case studies now of companies that have used crowdfunding maybe as add-on or maybe alongside a normal round. Again, crowdfunding isn't for everybody, but if you have, and I'm speaking with a little bit of bias here, I do believe it's preferred by companies who have a B2C kind of market, and an average consumer can kind of relate to it, be like, oh, okay, if I invest, sometimes they're investing like £30 in this, right? If I invest £30, this is kind of what I'm getting. If you're building some crazy network architecture, complex piece of, enterprise tech, it's very hard for the crowdfunding market to understand you, right? Because that's a disconnect. So if you understand why you want the capital, then it allows you to understand who you should go to. And then some of the things even Juliet said early on, like you understand, therefore, the size of the round to raise, what are the right terms, and pushing for valuation isn't everything. I think it's really, really important. I see, and sadly, you often hear this in the news because everybody's like talking about the valuation kind of starts the story, right? It should really not be the case, but sadly it is. So people think, oh, the higher the valuation, the more successful I am.
Well, one of the comments from the audience, from Liz, again, is, and was directed at Juliet, this exactly that point, the highest valuation is not what, as a founder, you should want. Wait for the right valuation. That can dazzled by high validations. I think that's a very nice way of putting it. Yeah, Juliet?
No, I think, to reflect, I think you should care about a high valuation when you exit. But the point is you're not going to be profitable for the next 6 rounds. You do a pre-seed, then you do a seed, a series A, a series B. It's a long journey, and I think you need to look at the long game and to strategize around that. And again, not to repeat myself, but there is nothing worse to do it around, I think, for the narrative. The journey is a narrative, and VC, it's all about the narrative and have a nice story. That's why there's so much media around it. And hence you need to control that narrative. And to be able to control it, you need to be very, very smart around each valuation round. I would say to go back to your initial question, for me, the most important thing for somebody who is raising for the first time is to leverage your network. I think network is the most important thing that you can have in the industry. This industry, it's so, you need to learn how to speak VC language, I think. And it's a little bit, out there, but it's doable. There are plenty of resources online, and I think leverage your network definitely, and create a momentum. The way that I judge, so when someone is pitching to me, I'm like, I try to think about this person. The way that this person is dealing with the round is probably the same way that he or she is dealing with the sales cycle with a client. And I want to be impressed by that, right? And so, I'll be scrutinizing this, definitely.
Very good point, Juliette. We have only 3 minutes left, so let's go to our question for audience. Just to remind everyone, the question was, what do you expect will be the financing sentiment in the fintech ecosystem in 2021? And the winner is, will return to pre-COVID levels. 54% of people voted this way. So before we conclude, Anishs and Juliette, I will ask you for your predictions for next year. You can be optimistic, realistic, or pessimistic. It's up to you. What do you expect 2021 to bring?
Well, I mean, as a founder, you always live in this bubble of optimism. So I'm always optimistic about whatever shows up. I also think there's been some, really interesting news happening both politically. I mean, the vaccines, multiple now. I think just everybody's hoping for 2021 to just kind of change everything, right? Including perhaps solving climate change, which I think would be a great outcome. So yes, a lot of optimism for what lies ahead.
Yeah, I would argue the same. I'm also probably a very biased, optimistic person, and I think you need to be if you're in the entrepreneurship game. So also pretty optimistic for the future.
Excellent. And in the meantime, actually, the voting has increased. It's now 65% of people who think that it will return to pre-COVID levels. So I think on that note, it looks like we're all optimistic. So let's be optimistic. Let's believe in the best companies. Juliette and Anishs, as you mentioned, the best ones will survive. We hope to see many more super successful businesses. I think this will make our life much more interesting and our life much easier. So on that positive note, I would say thank you everyone for joining us. I can see we had approximately 50 people watching us, which is excellent. If there are any questions, you can always reach out to us. But for now, thank you very much for your time. And thank you, Anishs and Juliette, for joining me.
Thank you.